Well, folks, we're back again with more updates on what is turning out to be probably the most eventful year in federal service in a long time. And this time, we're looking at potential changes to the Federal Employee Retirement System, TSP, FEHB, all over the board. There are changes that are being proposed that could affect federal employees pretty significantly. The House Budget Committee has already approved a number of cuts in spending in all kinds of different places, and there's a plethora of additional things being proposed. And recently, I came across a document from the Ways and Means Committee that talks about a lot of different changes that are being proposed, but most importantly, there is a section dedicated to the federal workforce and changes that are being proposed to your benefits. Now, before we jump in, I just want to make this clear that it is still in proposal mode. So obviously there is a process for making changes to the law and benefits. So right now we are still in these early phases, but we're keeping a very close eye on these proposed changes because if they are to come into play, they're going to affect federal employees in some pretty big ways. And so we're going to talk about those details today. So we're going to jump right on in. And this document that we have on the screen right now, this is the document and the excerpt, but I'm looking at the federal workforce changes, which is further on into the document. So the first one, and we'll just go in order here, we're looking at changing the FERS contribution rate to increase it to 4.4% of your salary across the board. So what does this mean? So right now, if you look at your pay stub, you might notice that depending on when you were hired, so if you were hired in 2012 or earlier, the amount of your salary that goes into the FERS pension system is 0.8%. And if you were hired in 2013, the amount is 3.1%, so a little bit higher if you were hired later. And for anyone hired 2014 and after, you're talking about a 4.4% contribution into the FERS system. So you're actually already used to this, but for everyone who is a little bit further, and mostly our audience, people who are later in their careers, planning for retirement, this could be a potential change that you see increasing your contributions from 0.8 to as much as 4.4%. This is an increase of the contribution that you will be forced to make into the FERS pension system. One of the reasons they're doing this is because many pension systems are having liquidity issues. Social Security is a good example of this. Tons in the private sector that have not been sustainable over time. The challenge with this is because there's more and more people living longer, and so they're trying to recover some of these costs by increasing the contribution amount. What this means is that your take-home pay could go down if this gets implemented in the system. Now we'll go to the next one here, where the proposal is to eliminate the first supplemental retirement payments. So what exactly is this? This is commonly known as the Social Security annuity supplement. If you can read my chicken scratch handwriting. This is a really nice benefit for some federal employees who, if retiring prior to the age of 62, you don't have access to Social Security yet, but you might be a minimum retirement age because you have 30 years of service, and you might decide that you want to retire. So to help bridge the gap between when you retire, possibly as early as 56, 57, all the way to 62, which is when you're first eligible for Social Security, even though it's reduced at that point, this is where the annuity supplement comes in. So it's a part of what your benefit would have been, and it's a really nice benefit for a lot of retired feds. Now, what they're saying here is that this change will align the federal policies to be more closely aligned with the private sector. What they mean here is that in the private sector, folks don't have a pension generally, and so you can't access Social Security until at least 62. And what they're proposing to do is remove that benefit from federal employees so that it equalizes it with everyone else in the private sector. Let's put some numbers around this so that there's some context around what this means. First, we'll say that the Social Security benefit at 62 for someone, let's just say, to keep the numbers nice and round here, $1,000 a month. So a rough calculation of what we call the annuity supplement is 30 over 40, so that's divided by, this is the ratio of the benefit that you would receive, so about 75% of the benefit that you would be receiving is what you would get in the annuity supplement. So in this case, if your benefit is $1,000 a month, then you would be receiving $750 a month from the age of 57 all the way to 62. And of course, if your Social Security benefit is higher, let's say $2,000 a month, then the estimate of your annuity supplement, $2,000 a month, 75% of that would be roughly $1,500 a month in an annuity supplement that you would receive. So almost $20,000 a year. That's, in this case, it's going to be like $18,000 a year. And remember, this goes through the entire time frame. So from 57 to 62, we're talking about almost $100,000 in less income, less benefit that you would be receiving. So obviously this is a rather significant difference. In this case, someone with a roughly $2,000 benefit could expect to see $100,000 less over 5 years. This number could be more depending on your benefit. It could be less. It just depends on your work history. But one thing I'd like for you to consider is, if this becomes reality, how are you going to deal with this less income? Well, one way is, if you're not already maxing your TSP contributions, make sure you increase those as much as you can. Another way is you can save inside investment accounts instead of just your retirement accounts. So with any of the extra take-home pay, if you have any, then you can actually take that money and invest it, save it in an account that can grow for you and start to help make up some of that difference. For when you do separate from service, you have a little bit of extra cash to be able to bridge you over. I think what they're trying to do here is, number one, cut the cost. Of course, that's been the overall message so far, but encourage a longer service time. So this would push people to the age 62. That is their earliest available Social Security benefit under ordinary circumstances. Now, whether or not you should take Social Security at 62 is a whole separate discussion. You want to make that decision within the context of a retirement plan. We've got other videos on that on the channel, so be sure to check them out. All right, the next proposed change we're looking at here is that the retiree benefit, so in other words, the formula used for your pension, is potentially going to be changed to a high 5 instead of a high 3 salary. Now, what is the implication of this? If you don't already know, the way that your FERS annuity is calculated is they take what we call the high 3 of your salary. So it's not exactly the final 3 years of your service, but it's close to it because it's the highest 3 years of your salary during your federal career. This figure is then multiplied by the years of creditable service, and then you get this base amount that your FERS pension is calculated on. So if we're incorporating more years of service, then we're probably using some years where you had lower income as well, which lowers the overall average, thereby lowering the actual benefit that you're going to receive once you apply for the annuity. So again, let's put some numbers around this so that you guys have an idea of what this might look like. So let's say that the high 3 numbers salaries that we're using here are going to be $150,000, $160,000, and $170,000. Just keeping it simple. In this case, if these were the figures being used over those 3 years, then your high 3 salary in this case is going to be $160,000. This is the number that they're going to use to calculate your pension. But now let's look at what it would be under a high 5 scenario rather than a high 3. So we'll still assume that you still had these 3 as your high 3, right? Because this is still part of your overall income history. But let's say that prior to that, maybe you were promoted to this 150. So before then, you actually were looking at $130,000 in salary, and prior to that, 120. So now if we take the rough average of all of these 5 figures instead of just the high 3, now we're looking at a figure that's being used of $146,000 for your pension calculation instead of the $160,000 from before. Now, in both of these cases, if we assume a 30-year retirement at $160,000 compared to $146,000 at 30 years, what does the actual calculation break out to be? Well, at 160, not assuming the 10% bonus, we're talking about $48,000 in pension income, whereas with the lower 146, it's about $43,000 a year in a gross pension. So in this case, $5,000 a year less that you would be earning under a high 5 situation. Now, this isn't a huge amount, but there's more to this than meets the eye. First of all, $5,000 is not an insignificant amount. This is an amount that a lot of people really would be counting toward. And what you have to remember, your COLAs or cost of living adjustments are now going to be based on a lower figure, which over time, how much less income from your FERS annuity over time as a result of this change? If we were to do a present value calculation on that future cash flow, this would be a significant amount. And so we don't want to take this one lightly because this could have a significant impact as time goes on. So one of the ways that you can help protect yourself against this, kind of like the one from before, right? are you maximizing the TSP? Are you invested for growth if that's something that you're capable of doing? If you're already maxing the TSP, can you consider saving inside investment accounts as well? The only difference between a retirement account and an investment account is the way that it's taxed. And so here, you would be subject to capital gains, whereas if you take money out of the TSP, it's kind of like an income. The taxes are like you earned a salary. And so I actually encourage federal employees to start saving in investment accounts as well as the TSP, because you're starting to diversify the taxability of your assets as well, which is really going to help you later on in retirement. That's a topic for another video. We've got other videos on the channel about this as well. And the next one we're going to cover, I'm going to skip one. You guys can read that one on your own, is this idea of converting new federal employee workers to at-will employment unless they accept a higher FERS contribution rate. So this is going back to the 4.4% that you would have to be contributing to the FERS pension system. Now, under the current system, and many of you might know this, is that we have a merit-based civil service protection. What we're talking about here is at-will classification. So at-will employment has much different protections in place. And I will start by saying that I'm not an employment lawyer. So if you have some questions around this and its applicability to you, should this become a reality, then I do encourage you to seek that advice from an attorney. But I think what you need to understand is that you may be leaving some protections on the table. The merit-based system has some ability to protect yourself against wrongful terminations and other things like that. And what they're proposing here is if an employee elects to be classified as an at-will classification, meaning it's much easier for them to be fired, then they can maintain a lower FERS contribution rate, 4.4% or lower, depending if they started earlier. So this is going to be an election that federal employees may be able to make. And the trade-off is you get to not have to be forced into making a higher contribution from your paycheck into the annuity system. Again, one of the reasons they are proposing this higher contribution to the FERS annuity system is because we need to extend the sum of money, just like in Social Security, so that retired federal employees can keep drawing on that. As the population grows older and as more and more people collect from these annuity systems, they begin to create some strain around that. So this is one of the reasons that they are likely proposing this change. So the next couple we're going to skip. And the other one that I want to talk about here today is the adjustment to the limit of federal employee buyouts. So what we're talking about here is the incentive payment for leaving service. Currently, we've got a $25,000 minimum, and the expectation is that this would increase to $40,000. The other notable change here, and I think this one's actually a little bit more important, is that it would lower the 20-year VERA requirement that you need to have down to 15 years of service. So obviously this is designed to make incentive packages for more federal employees to leave service. And in addition to the actual reduction of the requirement, is they're looking at making a higher payment. So again, further incentive to try and get people to leave service. Personally, I think this one's an interesting play. I don't know why they wouldn't have started with this rather than the whole fiasco of the deferred resignation program. But what do I know? And the other one, this one is one of the more interesting ones. So let's look at this one pretty carefully. Moving the FEHB system from a premium share model to a voucher model. Let's talk about what this means. Right now, the government covers a rather large portion of the FEHB premium. It's just over something like 70%. I want to say maybe 73%, something like that. And you as the employee cover the rest of the cost. Now, a voucher model, which is what they are proposing, changes how this system works. And if you read the language that they have here, it's a little bit of legalese, but in plain English, what this essentially means is that there may potentially be a somewhat fixed amount, although maybe indexed to something like inflation, and that amount would be the contribution that the US government would be making toward FEHB premiums on your behalf. Now, the biggest problem I see with this is that healthcare inflation is not the same as normal inflation. It is much higher than the inflation rate on regular things. How do we know this? Well, all we have to do is look at the price of long-term care insurance premiums. Why do you think that John Hancock is increasing the federal long-term care insurance program premiums? The same is happening in other parts of the markets. Same thing with regular healthcare and the cost of health insurance. If you look at how quickly those costs rise, it tends to be faster than the cost of regular other inflation. So in essence, what this means is that federal employees may end up becoming responsible for larger and larger portions of their health insurance premiums. So how does this affect your plan? Well, obviously this is a bigger line item for your budget than you may have anticipated. Without speculating too far, I have theories that I think eventually FEHB is going to require Medicare. I've talked about this in the past before. Obviously, we haven't seen any literature on this yet, but if you think about how TRICARE or Postal or any of the other systems are structured, then it doesn't make sense to me that they wouldn't eventually implement a Medicare mandatory situation like they do for the other programs. But of course, we have to remember Medicare is only available to 65-year-olds and up, whereas a lot of federal employees are retiring again as early as 57 for normal. And if you're an 1811 or anything like that, maybe even much sooner than that too. So that was a lot to cover, and I am genuinely curious, what are everybody's thoughts? I'd love for you guys to jump in the comments and talk to me about what it is that you're feeling about this. What are the implications, and do you think any of them are helpful? Do you think this will be harmful? And also, folks, consider sharing this with one of your other colleagues, because if these changes come into place, we're going to have a lot of stuff to talk about in ways that you're going to want to consider preparing for a lot of these potential changes. So I hope this was helpful, and until next time, stay wise and stay wealthy.